All right, good afternoon, everyone. Thank you, MTI, for the invite to speak. It's always a pleasure to be here. A lot of interesting speakers that are rolling through this. I'm just looking at the market here real quick, and if we look at the Russell 2000 here, basically a flat-ish day, not a whole lot of excitement, so I think that kind of goes a little bit in line with the previous speaker said from a seasonal perspective that we're probably going to be due for a little bit of a breather here. At least that's my personal opinion. So without further ado, though, let's get started. Again, my name is Serge Berger, and I am the founder of thestudytrader.com. I think you made a great choice to attend this webinar today. Again, like I said, a lot of great speakers. What I do is I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they actually just simply overcomplicate things? That's right. I think traders make things much more complicated than they have to be. So today, what I am going to show you is a highly profitable three-pronged trading approach that has not only made me a lot of money over the years, but has also already allowed hundreds of traders just like you to lead a life of financial independence by reaching consistent profitability. How would you like to be able to get up in the morning and not care which direction the market is heading because you know you have a simple, a trustworthy, and most importantly, a repeatable process that consistently keeps you on the right side of the market? Furthermore, how would you like to be able to do this from, say, your beachside hotel room in Florida or your slope-side hotel room in the Alps? Well, that may sound a little bit silly, but it's actually a very realistic lifestyle to have if you learn to follow this straightforward three-pronged trading approach that I'm going to show you guys today. Financial freedom is what many traders aspire to logically, and my three-pronged trading approach has allowed me to live a wonderful lifestyle where I spend part of the year here in Florida and the other part in Switzerland. Success as a trader really isn't that difficult, and with the approach that I'm going to show you guys today, I know that everyone can do this. So let's get right into the presentation. Just quickly about myself so you guys can get a little bit of perspective. I have been very fortunate in my career to be able to work both on the sell side, i.e. the investment banking side of finance, I guess. That's really what's referred to as Wall Street, but also on the buy side. And what that's allowed me to do is work with some of the very best traders and investors in the world and see how they actually make money. But it's also allowed me to see multiple different asset classes. And now I'm very fortunate to be able to pass this knowledge on to my direct clients, my subscribers, my students, and of course my broad audience such as yourself. So that's just a little bit about myself so you guys can see where I'm coming from as we work through what is an extremely lucrative topic here over the next 40 minutes or so. Like I said in the introduction, I think it's all about keeping it simple when it comes to trading and investing, and it really doesn't have to be complicated. Most traders and investors do overcomplicate things, and the way they do that is by looking at too many conflicting data points. It is becoming increasingly difficult for investors and traders to focus on what matters because we have all these distractions from our cell phones to Twitters to emails and whatever else might be flickering throughout the day. So that's why it's all the more important that we have a straightforward process that allows us to stick to our rules, okay? Or another way of putting it is that the more straightforward your process is, the easier it's going to be for you to be able to actually stick with it. And if you actually think about it, some of the market makers on Wall Street, they only focus on one or two stocks, but they get very, very good at those stocks. And some of the very best traders and investors that I know only focus on one or maybe two types of strategies. So if the best traders only focus on one or two strategies, then why is it that so many private traders think that they need to become a jack of all trades when the pros don't even do that? Think about it. So the key to success, in my opinion, is to become an absolute expert at one or two types of setups, and then you look for those setups to take place across the universe of stocks, indices, and even other asset classes if you choose to do so. Okay? So that's a little bit about the introduction here. Now, like I said, what I'm going to show you guys today is a highly effective and repeatable three-pronged trading process. And I know everyone can do this because I've seen so many people do this. And I'm going to make a big claim here. I really think by the time you get through the next 40 minutes or so, this presentation will literally have changed the way that you look at financial markets. And that may be a bit of a big claim, but I've seen so many people come through this and have that takeaway that I feel comfortable making that claim once again. So again, I think by the time we're through here today, it literally will have changed the way that you look at financial markets. Before we do that, let me do a real quick exercise, and you guys can respond to this if you like. I tend to think that traders and investors fit into three stages. I think it's always good to kind of be honest with ourselves to see where we are in any skill worth learning in life. So if you're a beginner, you're probably in stage 1, you're just kind of reading and studying. If you are in stage 2, you've done this for a couple of years, but you're still kind of struggling with sort of the emotional aspect of trading and investing. And if you're stage 3, you've probably done this for a few years, but you're still either losing money or not making as much money as you would like to. And any of these stages are fair game. They're all good. What I will say is that you happen to find yourself in stage 3, you're probably very close to making this work. As the same as for stage 1 or 2 if you have the proper education. But I always like to encourage people in stage 3 because they're usually very close to making it happen, especially if you're listening to webinars such as these here today. Okay, now just quickly on the agenda so you guys know what I'm going to go through with you guys here today. I'm going to explain to you why identifying investor mood or emotions is critical to success as a trader and investor. I will then show you how to consistently find the highest probability points to buy any given stock, index, commodity, or currency for that matter. I will then tie all this together and give you the blueprint to this amazing three-pronged trading and active investing approach. Okay, so I hope you guys are excited. Let's do this. Okay, so I don't know how many of you guys are familiar with candlesticks, but I'm going to give you guys a look at candlesticks today that I think very few have ever seen before. And the reality is that candlesticks and candlestick patterns, there are way too many of them out there to actually bother to learn them all. Okay, and that's something that really differentiates me, the way I look at markets, from a lot of other people that look at the markets from a technical aspect, because I just really want to make sure that we keep it simple and understand that a lot of these patterns and terminology really are all telling us the same thing, so we can actually really keep it super, super simple. You want to use the most profitable ones of these candlesticks patterns, shocking as that might sound, because those are actually the ones that work, and those are the ones that actually tend to show up frequently and consistently. Okay, so let me give you guys a quick basic look at what a candlestick looks like. If you are familiar with candlesticks, this is going to be a good review for the next couple minutes. If you don't know what this is going to be a real big eye-opener for you. So essentially, when we look at candlesticks, you can either have an up day, which is this candle right here that I'm circling with the mouse right now. I'm sorry, this is a down day, excuse me. You can see the daily open, and by the way, I should say that this can be this terminology, and this is what we're going to go through here today over the next now 35 minutes or 40 minutes or so, is really something you can apply to any time frame. Okay, day trading, swing trading, long-term investing, doesn't matter. And you can also apply it to any asset class, whether it's equities, foreign exchange, commodities, futures, whatever, it doesn't matter, okay? And you guys will see in a minute why that is the case, okay? So this is applicable to anything. So this is a down day. You can see we had an open here. We had a lower close, but an intraday range that extended above and below this open to close range. The opposite, of course, would be an up day. You can see we have an open here, a higher close, and an intraday range that extends above and below the open to close range. Now, what this allows us and what this gives us is this sort of 4-point relationship of the daily or weekly or intraday, whatever it is, open to close to low to high relationship. And in my opinion, and the way I use this, what's most important is the close of that bar, or in the example that we're going to use today here is the daily close. Okay? Now, the other thing about candlesticks is that they're extremely visual. So about 60% of us have an easier time understanding stuff by seeing a series of pictures as opposed to getting a bunch of paperwork or code looked at. And in fact, I actually think this number is more closer to 80%. I think the majority of us have an easier time understanding stuff through a series of pictures as opposed to just looking at a bunch of words in description. And the candlesticks are extremely visual, and that's really the parallel I'm drawing here. So what I'm going to show you guys right now is how lucrative it is to use candlesticks, because they are so much more visual than, say, your bar or line chart. And what they do is they give us a clear visual representation of what's taking place on a chart, the price action, right? But really, and this is the biggie, guys, if you take nothing else away from this presentation than this, write this down. The way you want to look at candlesticks is, yes, understand that they're ultimately giving us price action, but you want to understand that what they're really telling us, and that's the real secret, and it took me about 15 years to learn this, the real secret is that they're giving us investor sentiment and investor emotions, or we could look at it as investor footprints as well. Okay, we're looking at price action through the lens of investor psychology and investor emotions. Okay, now note this is really important, what I just said, and let's continue. A little bit more about candlesticks. Well, besides the fact that they just work, the reality is that it's very simple to use them. You just have to train your eyes a little bit, and you will start to see these patterns take place, and you're not going to worry about what these patterns are called, but you are going to know that they are either showing you, a strong bullish or bearish reversal or whatever else you might be looking at here. So we'll talk about this here in the next few slides. It's all about decision making without emotions. How many of you guys in here feel like you're trading or investing with too much emotions? Most of the time, we tend to do that. Even myself, I keep falling into these traps, but I have a process that I've developed over the past nearly 20 years now where I've managed to eliminate those type of traps or quickly get me out of those. So it's all about decision making without emotions when we look at candlesticks. Okay? It's all about defined risk and clear stops before we get into the trade. The reason I chose a picture of this person here is because you can see here she is walking on this huge cliff, but she's got very, very defined risk, okay? Her risk goes from 0 to 100% in an instant, right? She goes above beyond that cliff and her risk goes from 0 to 100%. So that's the same thing with candlesticks. We know exactly where we need to get out, and we determine that visibly, not by some arbitrary number, but actually visibly before we get into the trade. So you have defined risk, clear stops, and really what else could you ask for? So let's look at a couple types of candles. Like I said before, a lot of people I think make this much too complicated. They look at all these different types of candles. This is what we're going to look at here is called a hammer candle. Again, the name is not important. But essentially there's multiple types of hammer candles, and I'm here to tell you that instead of learning how many of these different candles there are and what they all different means, what they all mean, I'm telling you that a hammer candle is a hammer candle. But what's important is where it occurs, okay? So let's look at this candle up here in the top left. It's labeled here as number 1. Let's assume this was a stock, okay? Again, this can be used in any time frame. It can be used in any asset class. And let's assume this was one day, this right here. Let's also assume that this stock had been trending lower for, let's say, the past few weeks. It could have been the past few days or the past few months. Let's just keep it simple and say this stock has been trending low for the past few weeks. Okay, so that's this kind of price action, right? Ultimately, the bears came into this day and they opened the stock here, but they dropped it, they sold it off intraday all the way down here. But something happened intraday that the stock rallied all the way back, so much so that it actually closed in the very upper end of its daily trading range, or in this case, it actually closed up for the day maybe, okay? Now, here's where it gets very interesting. There's two ways of looking at this. Now, one way of looking at this is what I call the CNBC way or the financial media way, which is to say that we are off the lows, Joe, back to you. In other words, yes, the stock has been dropping for a few weeks and the bears tried to push the market lower and then we closed off the lows, and that statement is correct. It's not incorrect, but it's completely misrepresenting, or I should say understating, what really truly happened. What really truly happened is that the bears, who have been in control of this market for the past few weeks, tried their very best to push this market lower one more time. They failed to do so miserably, so much so that they completely ran out of steam. There were no more sellers left. And when that happens, there's only one thing that can take place, and that's for the stock, in this case, to go higher, or maybe at the very least, just go sideways. Okay, so what we are witnessing here through the lens of price action, by which we detect investor psychology, investor sentiment, is that a point of maximum bearishness had been reached. In other words, all the bulls in this time frame had now turned bearish, and that's exactly where visibly the market should, and most of the time will, begin to start lifting higher. So far, so good? This is a really important point. Let's start to build on that. Let me give you one more example. This is called an engulfing candle, and again, I said before, the names of these candles are irrelevant. In this case, the name does actually represent the visual of what the candle does, but it's really not that important. Let's once again look at this and look at this through the lens of a multi-week uptrend, and let's say this was a stock. Okay, just to keep the examples uniform. So we had a multi-week uptrend. The stock ultimately came into this day. It gapped higher onto this day after having already run up for the past few weeks. Well, something happened and the stock completely reversed lower, so much so that it completely engulfed the previous day's price action and it closed at the lower end of its range. Again, we can look at this in two ways. We can say, well, the bulls, who had been in charge of this rally for the past few weeks, tried their very best to push this market higher one more time. But they failed to do so. Here, keep it up, and the market reversed lower. So the way that the financial media tends to look at this is say, oh, we're off the highs, Joe, back to you. Again, it's not an incorrect statement. The issue is that there's much more emotions involved in this point in time right here than that statement would make one to believe. In fact, what happened is that after a multi-week uptrend where the bulls have been in charge, they gapped it higher again, but they completely lost control of that game. They lost buying power. Okay, there were no more buyers left up here. After a multi-week uptrend, the bulls tried to push this market higher one more time, failed to keep it up there, and when that happens and there's no more buyers, visibly, there's only one thing to happen, and that's the stock to drop, or again, like I said, at the very least, start to go sideways. The more visibly obvious these candles are, the more important of a point in time we tend to witness on the charts. So let me skip through a couple of charts in the interest of time, and let's look at a couple of examples. We're going to look at the S&P 500 here first of all, and I'm going to show you guys this chart here. I'm going to zoom in on this chart here, I should say, in just 1 second. But essentially what we'll be looking at here is the S&P 500, which at the time gave us a waterfall sell-off, which was followed by exhaustion selling, a strong bullish reversal, and then ultimately a bullish continuation buying day. Let's look at this a little bit more closely. So again, we're looking at the S&P 500. You can see what happened here was that in October 2014, this is what we're looking at here. Who in here was involved in the markets in October 2014? Well, if you were involved in the markets, you would have remembered that there was quite a sharp sell-off. And you can see that the market broke down quite hard, ultimately came into these two trading days here in the middle part of October, where the bears, after having been in control of that market for some time, tried their very best to push this market lower one more time. Well, guess what? For 2 days in a row, not just one, but 2 days in a row, they failed to keep that market down. And what happened is that the market quickly bounced back to the upper end of its daily trading range 2 days in a row. And on the third day, which is what I like to call my follow-through buying day, The buyers came in, the bears scrambled to cover the shorts, and it was a dramatic move off the lows to the upside. Now again, we can look at this through the lens of what the financial media likes to call we're off the lows. Again, it's not an incorrect statement, but I think you're starting to get where I'm coming to here. It's the understanding of what the price action is telling us instead of just labeling it something. That is where the power lies. So instead of just calling these hammer candles or saying that we're off the lows, understand that the bears completely lost control of the game. What happened is after a multi-week downtrend, the bears tried to push the market lower 2 more times in a row, failed to do so. There were no more sellers left, so the point of maximum bearishness in this time frame had visibly been reached. You don't need 1,000 indicators for that. You can visibly tell on the chart. But the key to all of this is the follow-through buying day. Let's look at one more example. Here we're looking at the KBW Bank Index. And again, I'm going to blow this chart up in just a minute. You'll see that there was a bottoming process taking place, then there was followed by exhaustion selling, a strong bullish reversal, and ultimately a bullish continuation buying day. Let's look at this a little bit more closely. This is the KBW Bank Index. This represents banking stocks. If you are not watching this index, I would highly encourage you to do so. The banking stocks are important to watch on any given day. This is last October, or actually October 2015, I should say. I keep forgetting that we're already in November here right now. But this here is a very sharp sell-off that we witnessed in 2015 in October. In August. And after that initial sell-off, you can see the market kind of went sideways. But then what happened here is really curious. In one of the first few trading days of the month of October, we saw the banking index, or the bears, try to push this market below those August lows. And you can see they've miserably failed to keep the market down there. In fact, after pushing it down there, the market quickly reversed back higher, and the very next day it gapped up higher and it was off to the races from there. So again, we had the bears in control, right? So they tried one more time to push this market lower, but they miserably failed. So they ran out of steam. There were no more sellers left, and when that happens, which is visibly detected here in the chart by this long, strong bullish reversal and the next day's up gap, then we had a very clear, visible low in place that we could trade against. I'm going to do Q&A here in just a minute, guys, but yes, this works in any time frame, Timothy. So it works for day trading, it works for swing trading, it works for longer term stuff, it works in any time frame, in any asset class, okay? And so let me just give you guys a couple more examples. Let's look at one more example, and we're going to look at the Gold Trust ETF, the GLD, okay? What we are looking at here is a topping process, which is ultimately followed by exhaustion buying, a strong bearish reversal, and ultimately follow through selling. Let's look at this a little bit more closely. Here we're looking at the gold ETF, the GLD. As you can see, it had been rallying quite strongly for a few months. Ultimately came into this day here, which was already a bit of a bearish reversal from a candlestick perspective. But again, to me, what's important is the visibly most obvious points in time where the buyers or the sellers get exhausted. So after a very strong multi-month rally, the gold investors or traders tried their very best on this day here one more time to push the gold price higher, maybe possibly to these highs. They miserably failed to do so, and it was a quick, nasty bearish reversal to the downside, a bearish engulfing candle. And the very next day, the market actually gapped lower, and it was off to the races lower. Now again, we can look at this in two ways. We can look at this and say, okay, well, you know, through the lens of financial TV, CNBC type of slogan, you know, we're off the highs, Joe, back to you. But really what happened is that the bulls tried their very best to push this market higher one more time after having had a nice multi-month and then a multi-week rally. But the bulls completely ran out of steam. There were no more buyers left. The market reversed lower, gapped down the next day, and was off to the races lower. So you can see that we can visibly tell where the bulls got extremely exhausted. You don't need 1,000 indicators for that. If you can train your eyes to see and look at this stuff through the lens of investor psychology, you will see your P&L curve dramatically improve immediately, because you're now seeing this stuff through the lens of investor psychology, and people have a much easier time looking at the market that way than they do by naming an indicator something or a price movement something which doesn't really mean anything. Okay? Now, I'm going to skip through a couple of charts here again because we're in the interest of time. I want to quickly tell you guys my 3 steps to the trade. I think number 1, it's really important that we have a big picture view and understanding of what the market looks like at any given point. Okay, a lot of people don't think that's important. As a nearly 20-year trading veteran on both the buy and sell side, I can tell you, I promise you over the long term and over the near and intermediate term for that matter, this really matters. So make sure you understand what the bigger picture is. Where are we in the economic business cycle? Where are we in the interest rate cycle? Simple stuff, but you have to have an understanding where we are. Once you understand that, make sure you start only trading stocks or whatever your asset classes are in the direction of what this big picture tells us. And step number 3, make sure you then look for those strong bullish and bearish reversals, which I'll give you guys a ton of more examples on right in just 1 second. And by the way, I'm going to give you guys a whole bunch of setups that are working right now in just a couple of minutes. So if you were to look at this right now, for example, step 1, right now we're in quite an interesting spot actually, where economic data had been slowing for the past 2 years, but they've just recently started picking up, and also price action from bonds to equities to other parts of the market are starting to look better and better and better. So if we consider that, we can start looking more again towards cyclical stocks and things that are in the early cyclical expansion innings of a business cycle. And step number 3, then of course you look for those strong bullish and bearish reversals. And by the way, as a bit of a bonus secret here, let me tell you, you can actually reverse engineer this. You can actually start looking, if you come across a strong bullish or bearish reversal like the ones I just showed you guys, for example, and I'm going to show you guys a ton more in just a second, you can actually then reverse engineer it and see if this fits into step 2 and into step 1. Okay? So let's look at a couple things here. We'll look at the charts we looked at before, but through a different angle, and we're going to go through the step 1, 2, 3 process. The bullish reversal I showed you guys before on the S&P 500 was actually right here. This was October 2014. Step 1, at the time, the Fed was still very accommodative, i.e. dovish. The economy was still expanding in that cycle. And if you had been aware of that, it would have been much easier for you to start going in and buying that dip. And by the way, that dip, step 2, came right into the 2011 support line. I remember getting a lot of phone calls from my clients, hedge fund clients, private clients, anything and everything around the world in this point in time in October 2014. They were all asking me, hey, is it time to freak out and sell? And I said, listen, step number 2, the Fed is still dovish. The economy is still somewhat growing. And step number 2, we're just now coming to this major support area. Let's wait it out a little bit. We waited a couple days. We had a strong bullish reversal. I gave the all clear buy signal, and we made a lot of money. So again, it's the perspective of the step 1, 2, 3 process that's extremely important. Now I'm going to skip through a couple examples here because I want to go through some real-time examples for you guys here right now. But I do want to quickly give you guys a bonus, my favorite options strategy. And my favorite option strategy, I've traded options for many years. And by the way, I should quickly say, before we get into options here just for a second, what I just showed you guys before can be used in stocks, options. It doesn't, you don't have to be an options trader. It has nothing to do with options necessarily. But of course, you can use options to trade on that. But my favorite option strategy is to look for stocks that have gone vertical, okay, and you sell out of the money call and put spreads against that. And the reason is when you have a stock that rises very sharply, like for example Tesla Motors did, or Amazon did, for example, last year, when a stock goes from a very steep slope into vertical overshooting mode, ultimately it tends to correct about 20 to 30 or 40% quite quickly. Once you see the bearish reversals take place, like I showed you guys here in just before, and I'm going to show you guys more examples here in just a minute, some real-time examples as well, and I want to see your tickers as well so I can go through your tickers. Once that takes place, you actually have a super high probability chance of making money selling out of the money calls or call spreads, like literally 10, 20, 30% out of the money if you do it right for monthly income. The reason for that is because implied volatility actually tends to increase at these crests up here, and that's because the smart money starts to scale out of some of these stocks and buy protection, and the premium on the options actually starts to tend to rise. So that's a little bit of an insight, just a couple minutes insight into my very favorite options strategy. Unfortunately, I don't have enough time here to go through it in detail, but that's a bit of a glimpse into my favorite option strategy, and I've been trading options now for about 15 years. So in summary, and let's go through some examples here though, the important takeaway is this. Candles show investor footprints and emotions. We need to have a very straightforward and repeatable process because that is the key to consistent profits as a trader and an active investor. Okay, the three-pronged process is as follows. Number one, understand the market structure, i.e. the market environment. Scan for technically sound stocks or commodities in the direction of that big picture trend, big picture backdrop. And number three, use the 1, 2, 3 bullish bearish reversal trigger as your signals. Okay? Now, let me take some of your tickers, guys. Please show me some tickers you want me to look at to look for these strong bullish and bearish reversals so I can help you guys out right now and so you can start applying this type of analysis right away as well. The first one here comes from Nike. So the chart of Nike, it's actually a good one. What you'll notice here is that the chart of Nike actually gave us a very strong bearish reversal here in December of 2015. So that's actually just about a year ago. But look at that. Look at what happened here. And again, you can apply the same exact methodology that we just went through. So we can see that Nike rallied very strongly last year. It then came into this period right here where the stock lost upside steam, and ultimately what took place here on this day, which was the 23rd of December of 2015, you can see that the stock, the bulls tried their very, very darndest to push this stock higher. Visibly you can tell it that they tried very best to push the market higher one more time, dramatically lost steam, I mean completely lost control of the game, and the stock started reversing back down lower. Okay, the next day we had a follow through selling day to the downside, and it was off to the races. Okay, so that's a beautiful example. You guys can see how visibly obvious that was. So many people get caught up trading all this nonsense in between here, which is all low probability stuff. Focus on the extremities where you have a clear visual representation and confirmation that the bulls are reversing it or that the bears are reversing it. That's what you need to get to. If you can do that consistently, not only is your profit and loss your profit's going to dramatically change for the better, but also you are going to start looking at the market so much less stressful. Okay, let's look at another one. For example, here people want to listen. Let's look at Facebook. Okay, so look at Facebook for example, and let's look at the moving average here. The red line here is the 200-day moving average. Look at, for example, this point in time right here. Let me just quickly zoom this out. And you can see that the very strong bullish reversal, very much like I just showed you guys in the examples, we had a sell-off, we had seller exhaustion. The sellers tried their very, very best to push this market below, in this case, the 200-day moving average. You can see they closed well off the lows on that day, up gap 2 days later, and strong move back to the upside. You can visibly see that. All you have to do is train your eyes a little bit to look for these spots, but you have to wait for confirmation. Then the stock rallied, came into this spot right here. The buyers exhausted themselves. You can visibly see that by not being able to push the market higher one more time. The very next day, follow through selling confirmation, and boom, it was off to the races lower. Okay, so you guys are asking a lot of great questions here. Let's go through some of those here in just one moment. What I do want to do is I want to offer you guys my ultimate candlestick bootcamp. And what this is, you're going to learn in great detail my institutional three-pronged trading approach, which is my low-stress, high-probability way of swing trading, where you're going to learn is how to nail reversals by correctly reading investor sentiment and emotions using candles and more. This is an 11-part recorded video series. Each video is about 15, 20 to 30 minutes long. An 11-part recorded video series, and includes my bonus 30-page course guide. Usually, this sells for $247. Today, we are selling it for just $97, one-time payment. Okay, just a one-time payment. There's no subscription. This is just a one-time payment of $97. Usually, it's $247. It's an 11-part recorded video series. You can learn all this stuff in great detail. And we're going to look at more live examples here in just 1 second, guys. Let me just type the link in quickly here for you, thesitetrader.com/1. Okay, I typed it into the bot as well, so that's where you can get this. There is a 30-day money-back guarantee if you guys care to take advantage of that. So again, it's just 97 bucks, thesteadytrader.com/1. I don't think this course is for people who are just trading for fun. I do think this course is for people that want to actually learn how to make money for real, reach financial independence, look at the markets through a less stressful lens, understand where the key turning points are by looking at the market itself. So if you're serious about making money and you're not just in it for fun, this course is meant to be for you. This course does, again, go through my institutional three-pronged trading approach. You're going to learn all the variations of the bullish and bearish reversals. You are going to learn how to use candles to trade both in the direction of the trend as well as against the trend. You're not going to have to use hundreds of candlestick patterns. You're not going to learn hundreds of patterns. You're going to learn the ones that actually work. Keep it very simple and straightforward, because over the past 15 years of using candles, I've learned to use which ones actually matter. So I can dramatically simplify it for you. Also, guys, in this course, you can learn about the rocket launch and gravity pull setups. Okay, very, very highly powerful setups. My probability enhancer, which is multi-time frame analysis, guys, and confluence zones. I'm going to show you guys examples in Target here in just 1 second using confluence zones. That in and of itself is worth thousands of bucks, but I realize a lot of traders don't have 5 or 6 figure trading accounts, so I don't want to charge you hundreds of dollars for this. I'm just going to offer it for you guys for $97. Again, it's an 11-part recorded video series. Each video is about 15, 20 to 30 minutes or so long, and a 30-page course guide that's really, really going to help you with beautiful charts. Also, guys, you're going to learn in this how the pros really use sideways channel breakouts using these candlestick patterns, wedge and flag pattern breakouts, lateral breakouts, trending gaps, how to correctly use resistance and support lines with candlesticks, moving averages and momentum oscillators, Fibonacci retracements, and much, much more. You're going to learn where to set your stops. You're going to learn about risk management, a little bit of the mental aspect of trading, and of course a little bit of money management as well. So that's all included in the course. I would strongly encourage you guys to take that course. So go ahead and take that offer. It's just one-time payment of 97 bucks. There's no subscription. thesteadytrader.com/1. All right. Now, some people wanted to look at Microsoft. Let's look at Microsoft. Okay. So we're looking at Microsoft here, and I'm just going to go and look at Microsoft here. I haven't prepped this at all, but let's look at Microsoft. And for example, Microsoft here, we had a real nice bullish reversal take place in, let me scoot back a little bit here, excuse me, in February, for example, okay, and even before then there in January. Look at, you can apply the same logic, okay. We had the sellers in control that came into a day like this, exhausted themselves, bullish reversal off the low, the next day an up gap, and it was a rally, okay? Same thing here. Look at this, the lows here in February. Long exhaustion candle, the bears failed to keep the market lower, close it off the lows. 3 days later, follow through buying, and it was off to the races. How about here in June? Okay, same deal. The bears were in control, they gapped the market lower, okay, failed to keep it down. The very next day, up gap, and even if you want to wait even a little bit more, we had another up gap 2 days later, and it was off to the races higher. Okay, if you guys can consistently start to learn to look at the market this way and understand that the price, the names of these patterns don't matter, but you have to look at them through the lens of investor psychology, I promise you guys are going to turn your profitability to the upside so quickly. Okay, so Target. Let's look at something like Target. Okay. Here, let's look at all the strong bullish reversal that took place here. For example, we actually just had a beautiful bullish reversal take place right here. These are all the things that you're going to learn in the course. You're going to learn how to nail these bullish reversals. In this case, we had a beautiful bullish reversal. Just literally, this was on election, the day after the election. You can see that strong outside bullish reversal, up gap the next day, and off to the races high. If you guys can consistently pinpoint these areas of the market and look at the market through the lens of investor psychology and not through the lens of just naming a pattern, you guys are going to see a dramatic improvement in your trading. So I would highly encourage you to take the course. Again, it's an 11-part recorded video series. It is each video is about 15 to 30 minutes long or so. The course also includes a 30-page course guide. Usually this retails for about $247. I'm going to give you guys today for just $97. That's thesteadytrader.com/one. Okay, so that's just a one-time payment. There's no recurring fee here. Don't have to worry about that. Okay, and you can see these patterns repeat over and over again. How about target? How about a bearish reversal? Look at the bearish reversal that took place here. Okay, very strong rally to the upside. Ultimately became into this day. You can see the bears or the bulls failed to keep the market up here. Very next day, confirmation selling or follow-through selling, and it was off to the races lower. Now, you want to talk about confluence zones? This also happened to occur at a beautiful Fibonacci retracement level, which was a 61.8% Fibonacci retracement. So you had double confirmation. It's what I call confirmation confluence zones. You're going to learn about those in the course as well. So really, really powerful stuff, guys. If you guys can learn to look for these confluence zones and understand the price action through the lens of investor psychology, you guys are going to see a dramatic improvement in the way your profit and loss statement looks like. In other words, your profits are going to dramatically improve, and you're going to trade with much less hesitation. Let's look at the IBB. This is the biotechnology ETF. Someone wanted to look at that. Look at the IBB, and what you can see here is very similar type of price action. Every single time this year we dropped to the lower end of the range, you can see we have these exhaustion selling moves followed by up gaps. Exhaustion selling followed by strong confirmation rallies every single time, right? Same thing here, seller exhaustion, up gap and rally, or strong follow through buying, and again here. This here took place just after the election. You can see this. The sellers got exhausted, right? That means you had a consolidation day and an up gap the next day, and booms off to the races. Guys, is this starting to make sense? This is really, really, really powerful stuff, and I really would want you to learn it, because a lot of people are just in the business of reading books about trading and learning all these funny pattern names, but the names don't matter. What matters is what the price action is trying to tell us about investor psychology, investor emotions. Okay, so this kind of stuff repeats over and over and over again, and if you can learn to look at the markets like that, then you have a dramatic upper hand versus the rest of the market players. I'm going to give you guys a stock right now that I'm looking at that may be on the verge of giving us a bit of a nice bearish reversal. It's DRI. This is Darden Restaurants, okay? And you can see we have a very similar type of move take place. The bulls tried to, obviously blasted the stock higher after the election, but then more and more we started seeing some signs of buyer exhaustion over the past few days. Well, yesterday we had what I would call a minor bearish reversal or a minor seller day, which today is being confirmed even more. So in my opinion, this is a stock that probably is due for a better pause. That's not to say that you have to short the stock, but it's something worth considering here, maybe on the short side, or at least take some profits on the long side. So again, you can visibly see what's taking place here. Visibly, the bulls ran out of steam. They're giving us bearish reversals, visibly confirmation selling, and I would think this stock is probably capped for right now, right here. And the beautiful thing about all this, and again, you learn this in the course, is that the stop losses are extremely well defined. So if in case the stock were to rally strongly and get above this point, that is an automatic stop loss. So again, all this stuff is very detailed described in the course. So I would encourage you guys to go ahead and take that course. Again, it's just $97. thesteadytrader.com/one. Go ahead and take that offer. It's a one-time fee. There's no recurring charge, and would love to be able to welcome you guys. And with that, I think I am just about out of time, and I will pass it back to the hosts. Thank you guys again for making time for me to present, and I wish you guys good luck with your market endeavors and a good rest of the day.